Breakout trading, just a perfect way to learn how to buy tops, sell bottoms, and then be left holding a massive bag of L's. I'm sorry, I mean, that's just the reality, and that's how a lot of people are going to either quit or learn when it comes to trading breakouts. Now, there's no strategy that necessarily is better than others, and breakout trading for some just doesn't work. They just can't wrap their head around it. They can't trade it properly, and they're much better being a dip buyer. But the purpose of today's video is to get us on the plus side or the positive side of the statistics when it comes to trading and then even breakout trading more specifically. So by the end of the video, we're going to have a step-by-step plan to plan your trades, identify setups, and then execute the breakout trade. And we're also going to talk about scaling and stop losses. So make sure you stay to the end if you want to hear about that, because when it comes to that part, the selling of the position, there's something that's really important that you must do first. Once you do that, things can fall into place from there. First things first, we need to understand where breakout traders go wrong. And it's called bag holding. And we don't want to be the bag holder. You probably heard about that in other contexts and other examples and stuff. I have been that guy. I no longer am that guy. And I now pretty much solely focus on breakouts. From my investment portfolio, a different story. It's more dollar cost average approach. But from a trade, any trades, swing trades or day trades, it's breakouts. There's no, I think this is going to bounce here. I'm going to do this. No, we don't do that. We just trade one strategy, and that's breakouts. And so that's why I want to make this video. I'm going to dive into a specific futures product that I would recommend. But in this case, we're looking now at the S&P 500. The reason why I want to cover this one product in a minute is because it's the best entry-level way to get into futures. There's more than one out there, but it's where I'd recommend you start if you're starting to get into futures, or if you're looking to get into futures and you want to start breakout trading. It's going to be a much easier way to get into it. But we don't want to be holding the bag, okay? Now, what does that actually mean? Here's an example. So we're looking at a 1 year, 1 day chart. The time frames don't matter too much, okay? We'll talk about, if you're a swing trader or a day trader. I kind of do both nowadays. I'm testing more of a swing strategy. I've been more focused on breakouts day trading wise as of late, which have been working really, really nice. But now I want to say, okay, can I bring this over to the swing side and can I make this work? And so as of right now, here's a 1 year, 1 day chart where you had this double top high, okay? And we broke out. We broke out weeks later to the upside in the S&P. But what ended up happening here was we ended up having this breakout, which one can now classify as a false breakout. So it popped up here and then it came back down. And a bag holder is still holding this thing all the way down the entire way. Now, of course, eventually they sell at some point where they just can't take the size of the loss anymore. We don't want to be this guy, okay? We don't want to do that. That's a bag holder, okay? So the biggest downside, and you'll see people say, yeah, breakouts suck because you end up, chasing highs and then selling lows. Now, some will do that, but there's a set of criteria that we can use to increase the likelihood of a trade working in our favor. And there's a set of criteria we can also use and follow to limit the losses. And so in reality, just like anything else, if you hear someone say breakout trade doesn't work, they don't know what they're talking about, because anything can work. You just have to craft a systematic approach behind the style of trading that allows it to work. That's all it is. It's not a very complicated thing when we unpack it, right? So that's step one. Step two, I want to start diving into these specific products and the actual nitty-gritty of breakout trading. But first, I do want to thank the sponsor of today's video, Jigsaw Trading. Jigsaw Trading offers traders an edge in the markets through powerful and intuitive trading software. With advanced tools for order flow analysis, visualization, execution, and advanced analytics and trade journaling, Jigsaw Trading gives traders a real-time view of market activity and helps them make better informed trading decisions. Whether you're a beginner or an experienced trader, Jigsaw Trading has something to offer, from their starter package to their professional package. Plus, their team of expert traders is always available to provide guidance and support. Take your trading to the next level with Jigsaw Trading. 14-day money-back guarantee. Try it today. Thanks for Jigsaw for sponsoring today's video. All right, awesome. So The futures product that I'm going to recommend here is going to be the micro E-minis. So if I go over to TradingView, which we'll leave a link to TradingView as well down below underneath the link to Jigsaw Trading if you guys want a resource here. But if I want to go to micro E-minis, I'll type in MES over on TradingView and I'll pull up the current, what's this, like September expiration? The current September expiration micro E-mini contracts on the S&P. Now, the reason why I mentioned this is because every point on the S&P. So for example, let's go into the 5-minute chart here. Let's say I took a position right now at, what is this, 53 or 45, 35, 50. If we went 1 point up, so 45, 36, 50, I'd be up $5, okay? Every tick, so 0.25 of a point, is about $1.25 in terms of P&L. So you could try this and practice this with one contract, and you're not talking about thousands of dollars swinging on your P&L, right? Now, as you size up or scale up or get better, you can start to say, okay, I'm going to take 5 contracts. I'm going to take 10. And then eventually you can move on to the more leveraged future products. But this is one of the best ways to do it, micro E-mini S&Ps. There's also micro E-mini products for the NASDAQ, the Russell, I believe crude oil as well. So there's other ones out there, but I would recommend looking into the micros first if you are someone who's trying to test different strategies or get your feet wet into futures. So the next thing we want to do is we want to mark up our charts. And so I want to go back to that S&P chart because that was just an easier way to look at things. So I have a lot of marks already on the chart. So we want to mark our charts up. We want to draw in trend lines. We want to draw in resistance levels, key levels. And so we've got videos in the past on the channel covering technical analysis, drawing levels and all that stuff if you really are new. But this isn't like insane. This does not have to be insanely complicated, insanely difficult. We just want to get a sense of the overall context, like what's going on. So let's say that I'm a day trader. Do I care about the weekly charts, the daily charts? Not really, but they're important. So I'll start, generally speaking, on the daily charts. So the 1 year, 1 day, what do we see? Generally speaking, we are trending up. Yes, today is a nice red day, actually, which is the first one we've had in a while, but we're trending up. Okay, so the general overall context is up as of late. Then I'll go to the 1 hour chart and I'll start to get a picture of what's going on here. Inside the 1 hour chart, what I see is still an uptrend. And then more so recently, we're starting to break down a bit as we're breaking down underneath some of these recent higher lows. So that's telling me maybe we're starting to break this trend, okay? So that gives me the overall context. Now, why is that important? It doesn't need to be super complicated. It's because, do you want to trade the opposite direction on a breakout than the overall context? Probably not. That's one of the criteria that realistically, when you broaden it out and do the analysis yourself, as in tracking your risk reward, tracking your win rate specifically, you will find, as I have found myself, that when I try to trade 5-minute breakdowns in an overwhelming uptrend on the 1 hour chart on the S&P, and I tried to go for 5-minute downside breakouts on the 5-minute charts, they tend to win a lot less when the overall trend has been up the past couple of days and weeks. When the trend's been down the past days and weeks, those breakdown trades tend to work a lot better, and I have a higher than 50% win rate. So it's simple. It's not like it has to be super complicated, but this comes down to testing it out yourself or listening to someone who's done it already and then implementing that yourself. So you're kind of trading with the trend, if you will, right? If the overall context doesn't fit maybe what your shorter term time frame context or trade setup is telling you, then maybe just don't take the trade. And that's something that I have been doing a lot more as of late, where some days I just won't trade if the context isn't there. So then I have some lines drawn in here and I'll identify key support resistance levels. So one key level that we had was this level right here. We had a resistance level that we saw. I'll draw one more in right here. We're starting to break down below that. That's levels where we have at least 2 touches, more from a horizontal perspective. Trend lines, they're cool. I don't really care. They don't need to be used that much in my opinion. They can work for some, but in this situation that we're playing here, right, it's pretty clear we can tell that we've got a series of higher highs and higher lows. Do I need to put a trend line on this to mark it specifically and get all caught up in like, oh, well, the trend line's not working perfectly here, so let me draw it this way. You can draw it a million ways. The overall trend, the trajectory here is what's important. So a series of higher highs and higher lows tells me we were in an uptrend. Okay, cool. Now, if I were to go back in time, we can kind of see the exact same thing playing out here, right? This past or that past period of time. And then what I did is I drew a line right here at this high, very close level marked up to this level. So very, very close, almost a double top. But that was an area of resistance that I drew in. Okay, eventually broke that resistance, and then we had a nice move up, and that could have been a swing trade or even a day trade potentially breakout to the upside. So in that situation, right, that was nice. You can go back in time and find downside breaks, and just more so recently we've been pretty much trending up, so we've got a lot of upside opportunities or upside examples to look at. But the same thing applies, and we're kind of even, if you maybe want to even start to get into this here, if you will, kind of seeing a downside breakout or breakdown occurring now. Is the best context? No. But you're kind of seeing how that works, right? You've got a level here, and we're now breaking below the level. Okay, ideally, I would like to have seen at least a couple more days of trending downside price action before this. So I didn't take this trade personally, but that's what you'd want to see in a perfect world. Okay, so that's the context. That's kind of setting the stage for the trade. Now, the next step, third step, I want to dive into what we're looking for more specifically to take the entries, right, on the trades. We want to look for high and tight or low and tight. And what I mean by that is high and tight would be a tight coil to the upside. So for example, let's go back to the daily chart here. And what I want to see is we have pressure on a resistance. So for example, what we drew this level in, right? We're struggling to break this. Are we staying high and tight? Now, in the context of the S&P, I'd say yes. Why? We had to push up, pull back. Push up, pull back. Guess what? Higher low. We are seeing a higher lows into a resistance level, which tells us when that breaks, we can get a nice breakout. And what we got was the day this broke, if you enter on this day, you actually had about a week or two of nice, consistent upside for a very nice move up. Okay, so the key here is that we want to stay high and tight or low and tight. Okay, and if we stay high and tight meaning we have a resistance, we're trending up into that resistance, we've got higher lows, we've got buyers, generally speaking, more buyers coming into that resistance. That's going to give us a higher probability that that level breaks, or that when that level breaks, we're going to get a nice move up versus not. Now, again, anything can happen. It could break and then false breakout and go right back down. That's given. We know that. It's not 100%, but we need something, right, to set this up. Because if we had, right, push like this, and then the market did this, right? Now, it could totally blast off the upside. But my experience is that when you have trades like that, for example, I push up, right, push up here, and then we have a big dip, and then it essentially goes straight from the dip to the rip, and it breaks out many times. Those are false breakouts, and we come right back down, okay? Many times. So we want to stay high and tight, showing we've got pressure into resistance. Once that resistance breaks, boom. And the same exact thing on the downside. And then the next piece here is patience. Like, this is not something that needs to be traded every single day. Number one, you can probably find this on the 5-minute charts more often than not. So let's go to the 5-minute charts for today. We're actually getting some nice breakdowns, or at least downs. Let's just say that I'm not looking at the S&P short until we break below this bigger picture blue line that we saw on the 1-hour chart. Okay, great. We're now below that line. Let's narrow it into the 5-minute chart and see if we can find some nice breakdown setups. And actually, what I see right here is 2 opportunities. Really 3, I even see. Now that we're under the level, we're looking for more of a breakdown below this level right here. We had one here, which was not high and tight. So reason why this may not work perfectly is because what we just said, right? We had pushed down 2 levels of, or 2 balance points of support. Then we came right here, and then we went straight and broke through straight. Not perfect, but could potentially work. The probability is not as high as if something was staying low and tight in this case, right? So for example, right, we got a little push down. Now this thing might come back and reverse. It might. So this is an example right here off the open, and then I'll draw one more line, which was right here. I'm going to get rid of this original blue line here. Okay, so what we're looking at is we had push down, bounce, consolidate, break the lows. Okay, push down, bounce, consolidate, break the lows. It's the similar pattern. So when we break these lows, we're breaking down, when we're breaking highs, we're breaking out, right, to the upside. So this is exactly the same thing on a 5-minute time frame, just now to the downside versus the upside looks that we were getting a few minutes ago. Now, what about stop losses? So let's just narrow this in, and let's just say that right now I was like, you know what? Here's my trade. I wanted to take the breakdown here because we had a nice push consolidation below the prior low, essentially turning support into resistance now. We're consolidating. If we break that, I want that to the downside. Let's say that that's my trade. Great. Go to Trading View, enter my trade plan tool, which is up here. And where's my stop loss? This is the most important piece to the actual execution of the trade. Where is the stop loss? This case, the stop loss is going to be at the highs of the recent consolidation. Okay, now why? So that goes right here because we're going to enter on the break here of lows, which we got on this candle. Our stop loss is going to be the prior, ends up being the prior support, turn resistance, right? The prior wick, but the top of the range of the recent consolidation before we get a breakdown or a breakout. Now, why is that important? Because that invalidates a trade. Some will play this a little tighter, and what you could do is you put your stop loss at the highs of the breaking candle. So in this case, it's a 5-minute chart. Could be more volatile because it's shorter time frame. If you broaden it out to the 1 hour or the daily chart, the candlestick that breaks out, up to the upside or to the downside, that breaks the pattern, that breaks out, that breakout candle, you can put your stop loss at the lows or the highs if you're playing short side, if you're playing long side, the lows, at the reversal of that candle. So if price action broke here, came back up, got above this level, you could stop out. Personally, on a 5-minute time frame, I don't like to do that. I like to give it to the top of the consolidation and then look for more downside. That's what I do. But again, every person's different, and this is something you can test out in your own trading. So I would recommend that you test it out yourself to see how it works for you and then your win rates accordingly, right? But now we've established a risk. Now, what I like to do for my profit targets, so let's just draw this in here, is start there. So now we have a risk. We assess the risk first. We map our risk first. Then we talk about profit targets. Okay. So in this case, profit target is going to be at least a 1-to-1. Now, why? Because this is a scenario where we can have a win rate that, personally, my win rate right now on breakout trades, now I trade a lot of stocks too as well, is somewhere in the 55 to 60-ish%. Some months I've had 60 plus. Some months have been like 53, right? So it's not perfect, but somewhere in that realm. So given that, what that tells me is, well, as long as I have a positive or a 50 plus win rate and a risk reward profile of 1-to-1 or better, I got a profitable system. Doesn't matter, right? So for me, I go 1-to-1 first. That's my first take profit. So now, as of right now, we've got a risk reward ratio of 1. Then from there, my next take profits, and this is something that we can customize to you, maybe something along the lines of 1.5-to-1, which happens to be like right here, and then 2-to-1, which happens to be right here, which both of those, by the way, would have hit. And maybe your last take profit is a 3-to-1. And so what I'll do is I'll take more than half of my position off at the 1-to-1 risk reward, and then I'll scale from there. Because there could be breakout trades where this goes for the entire day, and it just goes all day, trends all day, and it's a monster, and it ends up being a 5-to-1 risk reward. And those are your days that are going to be the icing on the cake that's going to make your weeks, your months. But is that going to happen all the time? No. That's going to happen a lot less likely. And what you're going to see is that as long as you're consistently locking the gains at 1, 1.5, 2-to-1 risk rewards, and you're doing that consistent and taking the majority of your trade off at those levels, as long as your win rate's at 50% or better, you're going to be golden. So it doesn't really matter. So that's kind of my perspective. But again, the risk comes first, then we talk about the reward and take profits. That's how we go about it. So with that said, any questions, comments, leave them down below. If you want more insight, you want us to do some more examples, talk about this on different markets, whether it's oil, other stuff. Happy to do that in the future. But let me know in the comment section down below what you want to see next. Hit the thumbs up button. Consider subscribing. Any links, resources, sponsor of today's video will be linked up in the video description box down below. Thanks so much for watching, and we'll see you in the next one. Peace.